I'm Adam Myers. I lead the distribution team at Pengana. Thank you for joining us for this webinar update with Ted Franks and Claire Jervis. Ted is the portfolio manager of the Pengana Web Sustainable Impact Fund, and Claire is a senior analyst in the team. The format of today's webinar will be a short presentation of around 15 minutes, which will leave plenty of time for Q&A at the end. So any questions that you have about the fund, the economic environment, or specific exposures, please enter them into the Q&A box, which can be accessed from the icon on your screen, and I'm sure we'll have a very interesting conversation at the end. Ted, over to you.
Thanks everybody for tuning in. So as Adam says, we've just got a few slides to sort of set the scene a little bit, and then we're open for the Q&A, which is probably a better way to get into this. So the first of those slides that I've got to share is just a quick reminder of who we are and what we do. The Pengana Web Sustainable Impact Fund is a positive impact strategy. We invest in companies providing products and services which are solutions to sustainability challenges. That's the core theme, quite an easy idea really. If you look at this slide, over on the right hand side are examples of companies we invest in. So Active is a US company making components for electric vehicles. Arcadis is a consulting engineering company based in Holland, whose business is all about climate change adaptation. And SolarEdge is in the solar value chain, particularly in residential solar in the US, with power optimizers. We don't invest in the large bulk of companies in the stock exchange who are just doing the transition to try and become more sustainable. Those companies in the middle of this slide will be buying products from our companies to make the transition. And of course, we're really kind of actively not investing in fossil fuel and businesses at risk. So a quick couple of slides for me, and then I'll hand over to Claire for some more detail of some of the stocks. So I'm going to just give you the very sort of broad macro overview. And here's a slide which we thought, to be honest, you've seen enough slides of interest rate rises, and I think most people who are market participants are familiar with how quickly that's happening. So we've just chosen the Fed hikes. Roger Federer, in fact, obviously a tennis great, is also, I think, an official representative of tourism Switzerland, and obviously keen on a walk, as you can see from the photo. But this has been the feature of the quarter that we're looking at. And in fact, it's been the feature of the last 24 months, this question about the Federal Reserve of the US and other central banks around the world, how quickly they'll raise rates. And you can see evidence of that in our performance in the third quarter, and in fact, over the longer period as well. That's been a key variable for how markets have performed. But that's in financial markets, which obviously have their own path and equilibrium. In the real world now, partly as a result of this uncertainty around where capital market conditions are going, we are moving into a situation where globally we're looking into at least a slowdown, if not an outright recession, led by Europe, with the US probably the best place of the large regional blocks. And you can see here various forecasts for this year in the dark green, in the green bars at the top of the 4 bars, and then for next year in the blue bars, the forecast for global GDP coming in over time as we look out to 2023. So that's the sort of second key backdrop from a macro point of view. And that feeds into a number of features, but our strategy does have a lot of industrial exposure. The industrial markets have been more recessionary for longer, really. What we're also seeing now is that we're getting to a point where there's a very strong consumer slowdown on the way. The cost of living crisis is really around the world. This photo here is from the UK, but obviously most of Europe has a similar dynamic to it. So we really are seeing the sharp end of negative consumer sentiment and problems with all kinds of markets as a consequence of that. And so last slide for me before I pass over to Claire with a bit more detail, and also with some of the sustainability sort of headlines in the quarter. And of course, at the moment, we're still referring to the third quarter. We'll get into more detail more recent events if you want to in the Q&A. So this is the performance in the quarter. Through the first part into the middle of August, there was a decent amount of optimism about a slower rate of interest rate rises, and you saw the strategy, which has a growth tilt to it, and therefore benefits from a lower interest rate, lower inflationary environment, certainly in the short term, although we would argue in the long term that's not so important, but certainly benefiting the first part of the quarter. And then as prospects worsened, inflation was more persistent than people had previously expected, then some of that outperformance ebbed away. So I'll pass over to Claire, who's got a bit more detail now of some of the texture of that.
Okay, so taking a look at our relative attribution by theme in the quarter, you can see that the two weakest themes were well-being and resource efficiency, and that's predominantly due to stock-specific factors, which I'll come on to in a moment. Our strongest theme in the quarter was water management, and that was led by a really good performance from advanced drainage systems. And it won't surprise you to learn that our second strongest theme was cleaner energy, mainly off the back of the Inflation Reduction Act in the US. Now, the thematic selection effect, which you can see on this slide, that captures the relative performance impact from us not owning all of those companies in the index, like 85% of the index, which aren't aligned to a sustainability theme. So you can see that we actually benefited from not owning all of those companies in the quarter. And I said that our weakest theme was well-being, and that was really driven by our holding in HelloFresh, which you may know as the world's leading provider of meal kits. And HelloFresh has been dealing with consumer spending, which is coming under pressure. You can see on the left-hand side that the consumer confidence index has actually tumbled to the lowest rate it's been since records began. And that's making it difficult for HelloFresh to gain new customers. But the silver lining to this is that unlike a lot of its competitors and unlike a lot of supermarkets, HelloFresh hasn't risen its prices to fully offset the effects of cost inflation. So that means that their meal kits now look like better value for money today than they did 12 months ago. And that is helping them to still gain some new customers, even in this very difficult environment. And our second weakest theme was resource efficiency, and that was really driven by our holding in KION, which is a provider of warehouse automation solutions. And you can see on the right-hand side that almost half of KION's business is aligned to e-commerce. And of course, with consumer spending coming under pressure, people are just spending less money buying stuff online. But actually, the main driver of KION's weakness is what you can see on the left-hand side, which is this surge in orders in 2020 and 2021. And that's because when management signed these orders, they didn't account for the risk of cost inflation. So they're having to deliver on those orders today at prices that they set 12 or 24 months ago, long before the effects of cost inflation really set in. So that's been really painful for KION's margins. And it's also led us to question the fundamental quality of KION as a business. And it did ultimately result in us selling KION during the quarter. But we do still have exposure to the warehouse automation theme through our holding in Daifuku, which is a Japanese company, and it's been a lot more resilient during this difficult time. Also in the resource efficiency theme, we've seen weakness, broad-based weakness in semiconductor companies, not just in our portfolio, but at the index level as well. And that's because investors are waking up to the fact that this period that we've just come through with really strong demand, really tight supply chains that have enabled semiconductor companies in many cases to achieve record-breaking margins, well, that period can't go on forever. And with consumer demand in particular starting to weaken, investors are turning away from semiconductor companies and it's putting their share price under pressure. But it's important to note that Web holds companies for the long term, typically about 5 years. And so we don't buy and sell companies based on their position in the economic cycle. But probably more importantly is that, of course, the semiconductor companies that we do own, they are strongly aligned to structural growth drivers in the form of sustainability themes. So, for example, Infineon, which you can see in the middle of this slide here, they've recently upgraded their long-term target operating model. So that's what they hope to achieve on a forward-looking basis over the entire economic cycle. They've upgraded both their revenue growth and their margin targets purely because of how well exposed they are to sustainability themes like electric vehicles and cleaner energy. And we expect to see similar trends from Power Integrations, which is a provider of energy efficient semiconductors, and Silicon Labs, which provides technology for connectivity and Internet of Things, which is crucial for the decarbonisation of buildings. Now, I mentioned that our strongest theme in the quarter was water management, and that was really down to one stock, which is advanced drainage systems. Advanced drainage supplies stormwater infrastructure, basically plastic pipes. And of course, we've seen in the quarter, Hurricane Ian has been a really symbolic of the crucial need for this infrastructure as we see more and more environmental disasters. So advanced drainage is supplying that infrastructure, but not only that, they're also disrupting the stormwater market itself, because a lot of those pipes that you can buy today are made out of concrete, cement, or steel, and they're really bad for the environment in terms of their manufacturing processes. whereas advanced drainage uses plastic. And not only that, but most of their plastic is recycled. So they're a lot better for the environment, and they're also more lightweight, easier to transport, and easier to install. So advanced drainage is taking share in an already growing and critically important market. And of course, I mentioned that our second strongest theme was cleaner energy, and that's mainly off the back of the Inflation Reduction Act in the US, which is the third key policy from the US, which has been designed to accelerate investment in innovation to tackle the effects of climate change. The Inflation Reduction Act is by far the largest of the three. It offers nearly $370 billion in investment. And you can see that that's coming mainly in the system integration phase of the innovation S-curve. So that's where you're investing in accelerating uptake of established technologies, in this case, things like solar, wind, and electric vehicles. And the main beneficiary in our portfolio is probably going to be First Solar, which is an American manufacturer of solar panels, because they're going to be leveraging a manufacturing tax credit to build a new manufacturing plant in the US, which is going to be very cost competitive, but crucially provides domestic supply of solar panels to the American solar industry. And we've also recently seen SolarEdge, which is another solar company in our portfolio, make an announcement that they're also going to leverage that tax credit to open their very first manufacturing plant on American soil. But it's not just cleaner energy companies which are set to benefit from the IRA. You can see on this slide a whole number of companies in our portfolio which are set to benefit from provisions that have been designed to support decarbonisation of homes. So, for example, on the left-hand side, you can see Aptiv, Infineon, and T-Connectivity, which all provide critical components for electric vehicles. On the right, you can see Trane and Daikin, which provide energy-efficient HVAC, or heating, ventilation, and cooling systems, which can be some of the biggest consumers of energy in American homes, particularly in the hotter states. Power Integrations, I mentioned earlier, provides energy-efficient semiconductors, which can help to decarbonize a huge number of consumer appliances and electronics. And SolarEdge provides power optimizers for solar systems, as well as EV chargers and other smart home devices. And so they're set to benefit from a whole number of provisions in the IRA. And finally, although the name of the Act is quite clearly a misnomer because it contains a number of provisions which are probably going to be inflationary, one thing that it also contains is healthcare provisions, which are designed to tackle healthcare costs and help to bring down inflation. So that's things like extending the Affordable Care Act and bringing down drug pricing over the long term. So that just gives you a flavour of the provisions in the Act, but of course, the significance of the Act goes far beyond the individual provisions. Really, we're looking at a statement of America's commitment to decarbonisation, and that's coming from the largest provider of fossil fuels in the world. And with that, I'll hand back to Adam for some of your questions.
The first question that I'm going to kick off with, and some version of this question has been asked in every webinar that we've held this series, is to what extent do you think that inflation and interest rate expectations are priced into current valuations, and particularly for the growthier stocks that you guys tend to invest in? Maybe Ted, you kick off with that.
Okay, so I mean, clearly, inflation expectations and interest rate expectations have been a key driver of performance this year, and we are coming to the end of a potentially an inflection point after multi-decade sort of downward trend in interest rates. So that obviously poses the question. I think our current understanding, and I should point out, we're not, really a macro fund per se. We're a bottom-up stock picking fund trying to find companies where the impact opportunity they have gives a pathway for growth which is different to expectations. So that's really kind of stock specific thing we're looking for. But I would say that the current frame we have is that you get inflation peaking at some point in 2023 and interest rates peaking shortly after, probably in the first half, I guess. And I think that's probably reflected in current valuations. And as we've seen in the first quarter of this year, when if that expectation is proven dramatically wrong, there'll be trouble even at these value levels. But I think otherwise, the valuation levels here look pretty supported. We're doing obviously as much work as we can around that to make sure we really understand where our stocks are.
Great. So Claire, following on from that, has your approach changed at all as the environment has changed?
Yeah, it's a great question. I mean, fundamentally, our approach is to invest in companies which have long-term sustainable impact drivers. And so we tend to have a portfolio which is kind of more aligned to growth and quality. And that's very much still the same. We haven't changed anything about how we select companies for the portfolio. I think, though, as Ted alluded to, we are, I guess, paying an even greater focus than ever on valuations, because rising interest rates means a higher cost of capital. And that means that companies kind of have to work a bit harder to justify their valuations. So we've been doing a lot of work on modelling our companies and just making sure that we have a margin of safety around the valuations to make sure that they are attractively priced.
Great. Now, changing tack slightly, and maybe another one for you, Ted, the Inflation Reduction Act seems to be very supportive. Are there any negatives?
The Inflation Reduction Act is genuinely a fairly landmark event in our sector. I was part of the team that set this business up in 2009, and obviously there's been a steady drumbeat, and it's never really got to the point that it needed to in terms of properly combat climate change. I'm not suggesting the IRA is that answer, but it is definitely clear leadership from the US, and that is very much needed globally, not just because of the US heft economically, but also because the way they do things, the free market economy really going for climate change solutions is a big deal. So in that sense, it's very positive. The detail of it's also positive for a lot of stocks and directly supportive. That's fine. The couple of points about it. First of all, it's called the Inflation Reduction Act. That is a bit of a misnomer. There's not really anything in there that's going to reduce inflation. Inflation's a critical issue at the moment. And actually, you may argue that if you don't control inflation, the cost of capital rises, and it makes it harder to put the investment in place in order to make the transition. So there's a question there. There are some provisions in the Act which relate to drug pricing, which are just starting to come through on our health side, but you're not going to control inflation in the US by controlling drug prices alone. So that, I guess, would be perhaps a disappointment. The other kind of shame about it, I guess, is a slightly more specific one, which is particularly in the electric vehicle value chain, the domestic content production provisions of the Act have really made it quite difficult to see how quickly that rollout of electric vehicles could possibly happen, because the US doesn't have an awful lot of the right kind of manufacturing capability there. Well, it may still be possible. So there are, puts and takes with it. There's some element of trade friction as well because of those domestic content requirements as well. But broadly speaking, we're much happier to have it than not, by a long way.
Makes sense. Are there any other global policies that are similar to the IRA, either already in existence or currently being, being promoted?
Yeah, I mean, so there's a couple of points here. The European equivalent is Repower EU, and that, in a sort of classic European way, is a bit less dynamic, has got all kinds of social considerations attached to it. It's probably going to be, and more of it is going to salt away in the disbursement. It's not going to be so impactful, but still it is positive and it is helpful and supportive. And particularly, it helps address some kind of key areas around energy efficiency, which actually probably needs to have something a little bit more creative to help move along. So that's the obvious parallel that's out there at the moment, but it's much smaller than the IRA. The other point to make is that, and this is kind of a longer term trend, which really, I guess you sort of talk about the last decade, this trend slowly emerging and now being really manifest. And that is the idea of Western economies, where we've long been quite wary of industrial policy, taking on these big kind of bold industrial policy initiatives such as the IRA represents. And in that sense, it somewhat resembles the Chinese 5-year plan approach, sort of unusually, as a kind of much more directive top-down view. But the IRA is bigger and is going to be more impactful than any of the cycles in the Chinese program as well. But they're the sort of two parallels for it, really.
Thank you. Claire, given Kion's struggles, which you spoke about a little bit in your presentation, what is your long-term view on automation?
Yeah, so as I mentioned in the presentation, we still have exposure to the warehouse automation theme in the portfolio through Daifuku, which is a Japanese company. And fundamentally, we think the long-term prospects of warehouse automation actually look brighter than ever, because we are just coming through a period of, labour inflation, cost inflation, and it's become really more evident than ever that companies need to work hard to make sure that they are getting the best out of their people, getting the most out of the manufacturing inputs that they're buying. And warehouse automation is really important because it helps those companies to improve their manufacturing yields and maximise their labour force as well. So we definitely think the outlook is very positive. But as with anything, you also have to look at the company that you're buying. And I think with Kion, what we found is that, they just weren't doing enough, I suppose, to protect their margins, and were perhaps sacrificing their pricing in order to gain market share, which has kind of not really worked out for them. Whereas Daifuku perhaps has a much more entrenched market position, and so they've been able to be much firmer on their pricing. They've been able to pass prices on to customers. And so they've been a lot more resilient in this difficult period. So it's absolutely still a theme that we're very much committed to. It's still very much necessary for sustainability and for the decarbonisation of the industrial sector in particular. It's just that Kion wasn't the right exposure to that theme for our portfolio, I think.
Understood. A few ESG questions seem to be coming through. The first is HelloFresh is accused of forcing monkeys to work in sort of slave labor type situations. Will that impact on your position of the stock in the portfolio? Do you have any view on this whole scenario?
So I can take that one. So we are aware of some issues with HelloFresh around unionisation of some of their employees, and there have in the past been allegations about kind of difficult working conditions in their plants as well. And so we have engaged with the company on that. We are so far relatively satisfied with their responses, that they are taking good care of their employees. But of course, we always have to be aware of this. We have a very robust ESG research framework which we follow, which looks at things like employee health and safety, and we look at the data that we get from companies on employee health and safety, on things like turnover as well. So it's definitely something that we're very much on top of, and we are engaging with the company on it, but it's probably not something at the moment that we see as being material enough to kind of threaten the company's position in our portfolio.
Just coming back to that question, I'm not sure if maybe I didn't ask it that clearly. The concern was about monkeys that are being used to work picking nuts and things in some of the plantations.
I mean, that's not right, is it? I mean, if we do a relatively thorough job, I've no inkling that there's actual animals being employed to do work.
I'm not aware of animals being.
I know that there has been an article recently, and maybe this is something that we can do some further work and come back to people on, because I know that there has been an article recently that was published, I think first in the New Zealand press about it. So perhaps. Yeah.
Well, I should obviously, I'll be delighted to see that piece of news. We're in this contact with this company at least monthly, and have relationships with obviously executives who are actually a relatively larger investor for them. They do seek us out to speak to us. We've covered governance issues, employee issues, we've covered packaging issues. I'm not sure which markets they're in where they would be doing meal kits which would have ingredients which could be harvested by monkeys. I mean, they have some Asian exposure. I'm trying to wrap my brains for this. Obviously, Australia is a big market for them. They're largely Western Europe and the US, so I don't know what the monkeys would be picking. I'm always ready to learn something new. I'm not sure that any of that, and I also, again, always learn something new, keen to learn something new. But if that really is something that they're doing, we will obviously be asking about it straight away. yeah, so please do send if there's an article there.
Perfect. We will, for everyone on the call, we will post this subsequently in at least a newsletter or something, and I'll get back to the person who asked that question directly. The next question now for Claire is, given that there is meaningful state intervention in the semiconductor market, does that impact your investment thesis in any of these companies in any way?
Yeah, so that's absolutely true. And I think that there are a number of implications to that. The first is that what we've seen recently is that there definitely needs to be a more resilience in the semiconductor supply chain. And so from that perspective, kind of nearshoring and onshoring of semiconductor manufacturing is a good thing. However, it does come with risks. I think the main risk would probably be the risk of oversupply, because these companies are making huge commitments to build out capacity of semiconductor manufacturing. That does risk potentially oversupply and driving down prices if it's not properly managed. That being said, we do also have companies in the portfolio which would benefit from that state intervention. So Infineon, which I mentioned earlier, is currently in negotiations with the German government and the EU to leverage some of their stimulus spending and build a manufacturing plant in Germany, which is going to be heavily subsidized by policy spending. So that's also very good. And generally speaking, we think that although oversupply can be a risk, it's important to note as well that the semiconductor companies that we do own tend to be in quite well-positioned niches. They benefit from structural growth drivers. They tend to be very IP protected, patent protected. And so on a relative basis to the wider sector, they probably would be more resilient to that risk of oversupply.
Makes sense. Next question. Where would you like to invest? In which countries would you like to invest? You see opportunities, but you have concerns over the governance. Maybe Ted, you. Sorry, I'm not allocating the questions very well. Maybe Ted, you.
I mean, so this strategy is a developed market strategy. If we were to go for an emerging market strategy around sustainability, which is something we have, thought about, although we are a fairly careful business, and we try obviously to stay within our capabilities, and we see moving to emerging markets as a very distinct capability, really. So we don't really have a particular lens for regions that are more troubled from an investment point of view in terms of governance. Within developed markets, obviously there is still some texture to that. I mean, certainly governance and the relevant shareholder primacy is different in the US as it is from European countries, but there aren't really, in the frame of the companies that we have a mandate to invest in, there aren't really examples of sort of significant governance issues. The clearest exception to that is that I think the mandate, as we interpret it, would give us some license to invest in Hong Kong listed PRC stocks, which we have done in the past. And certainly, I think there's a concern there now about the rule of law in Hong Kong and what owning those shares really means. And so that's made us a little bit more hesitant there. So that's perhaps the closest to it, but it's not necessarily the same as a governance question on a company by company basis, on a sort of endemic basis, if that makes sense.
Great, thank you. And next question is, where are you starting to see value? Are there any sort of industries that are emerging that you're looking at very closely because you're really starting to see value?
Should I take that one? Yeah, so I guess there are two. Well, the main thing that I would say is places like the semiconductor market, anywhere where there's a strong cyclical exposure. Obviously, these are companies that are now trading on historic low valuation multiples, and so that can be a really attractive investment opportunity. But also, surprisingly, in the healthcare sector as well, which the interesting thing with the healthcare sector is that we've seen a number of companies have benefited really strongly from the COVID pandemic because they've been supplying test kits or vaccine services or things like that. And so that has driven really strong growth over kind of the last year or two. And what's happened is that a lot of investors are now kind of worrying what next year's growth might look like on the back of those really strong numbers. And so that's actually created a bit of uncertainty in the sector. and a bit of pressure on some companies' valuation multiples, which for long-term investors like us can create an opportunity, because we are able to look through that kind of short-term, 1-2 years of uncertainty, and seek to invest in companies that have a really strong, either a strongly growing market, like cell and gene therapy is a really exciting area, or other drivers over the long term which could benefit them, even though they might be facing a couple of years of uncertainty. And actually, one example which is quite pertinent to that is Fisher & Paykel, which is already in our portfolio, but they had a similar experience where they placed a load of these ventilation systems during the COVID pandemic, and then people started to worry, what are they going to do now for the next year or two, because there's been a huge pull forward in demand for these ventilation systems. But actually, taking a long-term view, these ventilation systems are still really underpenetrated in American hospitals. They've barely been rolled out in ex-US hospitals. And there's also an opportunity for their consumables, the little kind of cartridges that go into the ventilation systems as well. And so that's just an example really of how we've looked at a company that's benefited from COVID, come under pressure as a result, but over the long term should still be a really strong investment.
Great, thank you. I'm just looking through the questions. There are a lot of people who've posted comments with links. Obviously, people have been on the internet and have posted comments with links to one or two articles referring to monkeys being used to pick coconuts in Thailand. So we will definitely get back to you. The team will do some further research on that, and we will get back to you. But in amongst that, I think that I have asked all the questions except one, which I have purposefully saved until the end, because it feels like it could be an endless answer. So I'll start with you, Ted, and then maybe Claire, if you've got anything to add thereafter, you can finish off. But what are your thoughts on what was achieved, or perhaps what wasn't achieved at COP27?
So COP27, obviously quite a few things came out of it. It's generally seen as disappointing, and that's because the mood was actually somewhat defensive. So there was a surprisingly strong attempt by some countries to renege on 1.5 degrees as an aim. There was an attempt to strengthen language about the phase out of fossil fuels. It was rejected. And generally the tone of the negotiations was much less progressive from the previous COP in Glasgow than I think people had hoped for. So that's the kind of tone point of it. The landmark agreement is the Loss and Damage Fund. So this is a mechanism whereby developing countries will contribute to a fund which will be held somewhere separately, and that will be a kind of disaster response fund. And obviously very visibly we've had these big floods in Pakistan, but all over the world all the time there are vulnerable countries facing catastrophe as a result of climate change. It's good that it exists. It's very good that there is an acknowledgement on the part of developing countries that they should take some responsibility for that and share that pain. The details of how it gets dispersed are unclear, and there's always a slight worry because disaster funds are famously vulnerable to graft, so that's a problem potentially. But the text got through because we managed to separate some of the larger former developing countries such as China from those which are in the category which would need help under that. So that is a good thing without question. The other thing that I thought was interesting is the Bridgetown initiative, which is trying to effectively re-engineer the sort of financial framework of the IMF and the World Bank to try and make them more fit for purpose to sort of address some of the climate change challenges. That obviously is fairly nascent, but there was some progress there. And there's always other sort of interesting things in the fringes of COP. So quite a lot of discussion this COP around health as well. So, there's been 27 of them. Not all of them are landmarks. Not all of them are great progress. This one was, I think, actually okay. And I think loss and damage is something we would take as positive. I mean, Claire, if you have another view, do add.
Yeah, I mean, to be honest, I mean, the establishment of the Loss and Damage Fund is definitely a good thing. However, to echo the UN Secretary General, a loss and damage fund isn't much good if you've got an African country turning to desert because of rising temperatures, or another country that's losing its landmass to rising water levels. So the establishment of a loss and damage fund is definitely a good thing, but really that's reactive, because that's going to help countries deal with climate disasters. What we want is for countries like the Middle Eastern countries, China, who've been so resistant to raising their commitments to decarbonisation. We really need them now to wake up to the fact that this is crucial for them to do that if we have any hope of achieving the 1.5 degrees C target. I think that current estimates based on policies that exist today from countries has us reaching 2.4 degrees C by the end of this century. So we're not on track for 1.5 degree C target, and we do still need countries to step up to the plate and set proper decarbonisation targets.
Great, that's useful. Thank you very much. I do see that there was one other question that I had missed. So Claire, happy for you to have a go at this one as well. Do you have any positive examples of where your engagement has been successful with individual companies?
Yeah, so there's definitely loads of examples. Actually, the first one that comes to my mind is STERIS, which is an American company which provides sterilisation services and equipment to hospitals and other healthcare providers, because of course it's important, like it's so important for things to be sterile, right? You know, injections and clean rooms and things and surgeries. And the issue with STERIS was that, or continues to be, that they rely on ethylene oxide, which is a hazardous chemical. And basically we spoke to the now CEO of STERIS and kind of asked him about the use of ethylene oxide and what they're doing to control the risk from that. And he was able to tell us about what they've been doing to ensure that the fumes from ethylene oxide are being captured within their manufacturing plants. They are rolling out better equipment in countries that even don't have, so that what I've just said in terms of capturing the fumes, that is a legal requirement for America, but they also have plants in other countries where it's not a legal requirement, but they're doing it anyway. And they've also come up with targets which are aimed towards decreasing the use of ethylene oxide in their products. It's not as easy as it sounds, because actually to achieve the level of sterilisation that they need to achieve, there aren't actually that many substitutes available to ethylene oxide. So it is a challenge, it's an innovation challenge that they have to meet. But from our engagement, we've been able to encourage the company to be better in terms of their disclosure to investors on their ethylene oxide use and targets. And so we hope to see some better disclosure from them going forward. And of course, that would be an ongoing engagement with them as well.
So just to clarify, your engagement has been around the disclosure, not necessarily around the need to find substitutes.
Yeah, I would say, well, it's kind of both, because the disclosure is important for investors to be able to track what the company's doing. So STERIS, for example, is signed up to something called the Chemical Footprint Project. And that seeks to kind of track their commitments. And then from that, we can then, as investors working alone or with other investors, put pressure on them to do better. So it is around the disclosure, but it's also around putting pressure on them to phase out the use of ethylene oxide as fast as they can, to make sure that they are putting the right investments in place to substitute it, and just do everything that we can to make sure that their workers who are exposed to ethylene oxide are protected.
Great, thank you. I think we have answered all the questions. If we've missed anything, please get in touch. But thanks to everyone who submitted the questions, and thanks to everyone else for joining us this morning. Our next webinar in the series is next Tuesday, which is the 29th at 9 a.m. And it's with Fred Pollock from GCM Grosvenor, who are the manager of our listed private equity vehicle, PE1. You can register for this on our website, pengana.com. Thanks again for joining us. If you have any other questions, please get in touch and enjoy your day.